Okay, so these are going to be some examples from Chapter 12. And again, Chapter 12 deals with partnerships. So for this first question, Gina Sanchez and Carlo Torres are forming a partnership, Spanish leather goods, to import merchandise from Spain. Sanchez is especially artistic and will travel to Spain to buy the merchandise, and Torres is a super salesman and has already lined up several department stores to sell the leather goods. What is the purpose of the partnership agreement? Well, as you see here, most people go into and I'm not going to write, the first two components of this problem are just questions that don't require calculations, so I'm just going to explain those. Obviously, it seems kind of obvious why they're getting into business together, other than the fact that maybe they're friends as well. But they're trying to take advantage of strengths that the other person has. And a lot of times you'll see that's the reason that people form these business entities, is because they want to take advantage of strengths outside of their own, or take advantage just of manpower by having more than one person involved. But in this case, each person seems to have their clear strengths. So the basic purpose of having a functioning partnership agreement that's actually set out is to delineate the operation of the partnership by establishing the rules that will govern the partnership. Because of that, the partnership agreement, if it's written out, should contain the following information: the name, location, and nature of the business, the name, capital contribution, and duties of each partner, how a new partner is admitted, so the procedure for admitting new partners, the method of sharing profits and losses between whatever partners exist, how does a partner withdraw assets from the partnership, so the procedure for withdrawal of assets by the partners, and how does a partner withdraw themselves from the partnership, so the procedure that follows that. And then finally, the procedures for liquidating the entire partnership, selling assets, paying liabilities, and distributing any remaining cash to the partners. So, obviously there's no laws that state what has to be in a partnership agreement. There are laws that basically say if you don't have, and these vary state to state, but if you don't have this information set out, there are some standard, okay, you decided not to put this information in an agreement, this is what the standard agreement would say. And so they'll just basically apply whatever the de facto law is in that scenario, unless you have set it out in the partnership agreement. And that's why it's important to set all of that information out. For example, if the partnership agreement does not state the profit and loss sharing ratios, this is number 2 here, how will profits and losses be shared between the partners? And the de facto law for partnership law for sharing profits and losses is that if they're absent any other information, partners share equally the profits and losses of the partnership. So if there's two partners, that means that absent any information in the partnership agreement, they're going to share equally 50-50 profits and losses between the two partners. Okay, so this part 3 is where we actually have some numbers, some entries that we need to put down. So Sanchez is contributing $100,000 in cash and accounts payable of $20,000. Torres is contributing a building that costs Torres $75,000, but the building's current market value is $90,000. So how do we, or what entries do we put down on the partnership's books to record these, what seems like initial contributions to the partnership? Okay, so let's start with Sanchez. So Sanchez, is contributing cash, so that's an asset to the partnership of $100,000. It's kind of generous to say that Sanchez is contributing accounts payable. That's not really a great contribution since that's a liability. So basically, Sanchez is basically putting debts into the partnership. So obviously that's going to reduce the amount of capital that Sanchez has. So we'll record this debt. We're looking at this in the partnership's eyes. So if the partnership is taking on an account payable or several accounts payable, that is going to be a liability to the partnership, and that's why it's going to be added by increasing, or it's going to be increased by a credit entry here. So accounts payable will go up, and that is increased by $20,000. And then, of course, the last entry is going to be how much do we put in Sanchez's capital account. There are several ways to look at this. You can look at it through the basic accounting equation where assets equal liabilities plus owner's equity. And in this entry, we have all three of those. We have an asset, we have a liability, and then our last entry will be owner's equity. And you can figure out the numbers that way. Or you can look at this and say, okay, I have a debit of $100,000. I have a credit of $20,000. What do I need to make these make this journal entry balance? And the way that you do that is you say, okay, there's $100,000 on the debit side, $20,000 on the credit side. I know I need to put another $80,000 on the credit side to make it balance, and that credit is going to be to Sanchez's capital account. Okay, so that is what the contribution to the partnership looks like of the information given for Sanchez. Now, for Torres, and throughout your book loves, and I don't know that I've seen maybe more than a couple instances in the book where it doesn't do this, but it loves to throw these red herrings in here. And what that basically means is it's going to give you some information that may distract you, and you may think, maybe I need to use that information, when in reality, it's just there to kind of muddy the waters, to confuse you or to mislead you. That's what a red herring does. So we're given this information that the building costs Torres $75,000. Guess what? We don't care. All we care about is the current market value of that building. So building is going to be an asset, so we're going to debit the partnership's buildings account, and the amount we're going to debit that account for is $90,000 because that's the current market value of the asset that is contributed. There is no attached liability to that asset as far as we can tell from the fact pattern given. So the entire amount of the value of that building that Torres is contributing will be recorded in Torres's capital account. Okay, so that is how you would journalize these initial partnership entries. So let's move on to a slightly more complex partnership question here. Okay, so it says ABC is a partnership owned by Alders, Byron, and Calvin, who share profits and losses in the ratio of 1:3:4. The account balances of the partnership at June 30 follow. And here we see the adjusted trial balance with the account balances. Before I get into what we're asked to do, well, let me just read the questions and I'll come back to what I'm saying here. So question 1, prepare the June 30 entries to close the revenue, expense, income summary, and withdrawal accounts. So these are just closing entries for June 30. Then we scroll down here. I left a lot of space there because that's going to take a little space to do. Open each partner's capital T account with the adjusted balance. Post the closing entries to their accounts. Determine each partner's ending capital balance. And then finally, prepare the June 30 entries to liquidate the partnership, assuming the non-cash assets are sold for $120,000. Okay, so moving back up here. Based on those questions and the information given here, we know that at some point we're going to be given a number, and we're going to have to divide that number between the partners based on how they share profits and losses. And we're given this ratio in 1:3:4. So if it's divided up into that many parts, Alders gets one of those parts, Byron gets 3 of those parts, and Calvin gets 4 of those parts. So if you add those all up, that's assuming there's 8 parts. So all I'm going to do here, to make this a little bit easier on us, is I'm going to turn each of those ratios into a decimal so that when we get to the point that we need to work with those, we can just use each one of these cells. So you'll see that I did for Alders 1/8 because we have here in this example or in this ratio, we have 8 total parts, and one of those is Alders. So that's the decimal version of that number. Then here we have 3/8 because 3 of those 8 parts are going to go to Byron. And then here we have 4/8, which is the same as 1/2, or 0.5. So those are the decimal forms of the ratio of the profit and loss sharing for these 3 partners. And we'll get to when we need that in a second, but we know that when we do, we just have to scroll up here and we can see that. Okay, so prepare the June 30 entries to close revenue, expense, income summary, and withdrawal accounts. So looking up here, what revenue accounts do we have? All I see here for revenue accounts is sales revenue, $164,000. And that's a credit. See, credit $164,000. So to close that account, what I need to do is make sales revenue have a 0 balance. To do that, since it carries this 164 in a credit side balance, is I'm going to debit sales revenue for that amount, 164,000, and that will make sales revenue have a 0 balance. And then I'm going to credit income summary, which is just where I keep track of the revenue and expenses for this period as I'm closing them out. Okay, so that entry closes out my revenue account. Next, I want to close out my expense accounts. So the way that I do that is, since expense accounts carry a debit balance, I'm going to credit each one of those expense accounts that I see up here. And if I look back up here, I see salaries expense and rent expense. So I have 2 expense accounts. And those are both debits, so I'm going to credit both of those. So my debit entry for the expense closing is going to be to income summary, again because that's where I keep track of my revenues and expenses when I close them out. And if I were building an income statement, that's where I would determine my net income for the period. So since there's more than one expense account, I'm going to leave the number for income summary here blank until I total up my various expenses. So first expense account is going to be salaries expense, $74,000. It's a debit, so I'm going to credit salaries expense for that amount, $74,000. Whoops, that's 64. $74,000, and that will close out my salaries expense. Now I'm going to credit rent expense for $12,000, and that will close out rent expense. So now, assuming that these are actually the only revenue expense accounts that I have, after these 2 entries, those both, the revenue and the expense accounts, now both have a 0 balance in them. Okay, so the first part of this, close revenue and expense accounts, that has been done. Now I need to close the income summary account. And to be able to do that, let me write over here. I'm basically going to show you right here what my income summary T chart would look like. So this column here is going to be my debits. This column here is going to be my credits. So in this entry, I had a credit to income summary of $164,000. And then here, oops, I forgot to put the number in here. I just add up these 2 numbers, and that's my income summary amount here to balance. So that's going to be $86,000. And that makes, let me just make this a little prettier, sorry. Okay, sorry, that's my OCD kicking in there. And on the debit side of this income summary T chart, and again, if it was a real T chart, I would have a line going across there and going down the middle to form my T. But the Excel spreadsheet gives me enough of a T to make this work okay. Okay, so I have $86,000 in the debit side, $164,000 on the credit side. So I know that as of right now, this account is carrying a credit balance. And to know what the balance is, I will just subtract 86,000 from 164,000. 164,000 minus 86,000. Okay, so it's carrying a credit balance currently of $78,000. Now, to close income summary, since it's carrying a credit balance, to make a zero balance in income summary, I need to debit or throw a debit into this T-chart of this amount. And so that will then make the total in income summary 0. So I'm going to debit income summary for $78,000, and it is now closed because it has a 0 balance. And what I'm doing with that is I'm basically taking my net income for the period, because net income is revenue minus expenses, and I'm now going to divide that up between the various partners and add it to their partnership capital accounts. So I have credit to A capital, whoops, you get the gist there. Credit to B capital, and credit to C capital. And here is where I'm going to need what I calculated up here, the percentages for sharing between those partners. So for A capital, I'm going to do a little equation here, and it's going to be 78,000, so I just clicked on that cell, and I'm going to multiply, so I just pushed the little asterisk there to denote that I'm multiplying, and then I click this cell. And so you see right here what I'm doing here. It shows the two cells and I'm multiplying them together. When I push enter, it will show me the calculation gets me $9,750 going in to partner A's capital. Then I'm just going to do that same thing. 78,000 times for partner B, what we calculated, which was right there. And that shows me 29,250 going into partner B. And finally, 78,000, whoops, times partner C. Okay, so you can see here, if I just add these up, I'll delete this in a second, but just so you can see that they sum to this same amount and we balance here, we've got a 78,000 on this side and a 78,000 on this side. Okay, so now I have closed. I've done the first three parts of this, which was revenue, expense, income summary, and withdrawal. And now, or I'm sorry, and up to income summary. Now I'm going to do the closing of the withdrawal accounts. And so I'm given here in the question how much was withdrawn from each of those partners' accounts. And since those are debits right here, to close those withdrawal accounts out and give them a 0 balance, I need to credit each one of those. So starting with partner A, my debit is going to be to A capital because capital accounts carry a credit balance. I will be lowering each capital account by whatever amount they withdrew money during the year. So in partner A's instance, it shows me, whoops, too far. Right here that partner A withdrew $9,000. Okay, so I will debit partner A's capital account for $9,000, and I will credit a withdrawal account for $9,000. Okay, So I've now closed out this partner A withdrawal account. This has a zero balance, and I'm going to do that for each of the other partners as well. Debit partner B capital for $27,000. Credit B withdrawal account for $27,000. That closes out that second one. Debit C capital account for $49,000. Credit C withdrawal account $49,000. Okay, so with those three entries there, now all the withdrawal accounts have a zero balance, all of the income summary accounts have a zero balance, all of the expense accounts have a zero balance, all of the revenue accounts have a zero balance. And the effects of all of those accounts have gone into the individual partner capital accounts. That's what we needed to do for that question. Or at least for that portion of that question. So now for the next portion of that question, we're basically want to do a T-chart for each partner's capital account. So I'm going to just format that real quick off screen. And I'm back. And now you see here, I just have the T-charts formatted for A, B, and C's capital accounts. And all we're going to do is we're basically going to go in, we're going to look at the entries that we did right here. We're also, I guess, first thing we're going to do is go in and see what the balances were in those capital accounts before we messed with them at all. Okay, so A capital had a credit balance of $22,000. Okay, so $22,000. This is my starting balance. And I'll do that for each of the three partners here. So we had A, whoops, what did I put there? Yeah, A had 22,000, B had 50,000, and C had 53,000. Okay, so these are, and I'll put it out to the side here, starting balances. Okay, so now I'm going to look at anything that I did to the partner capital accounts in these entries that I did here. So let's see, first entry, I don't see anything in capital account. I don't see anything in capital account right here. Okay, I see these three going into various capital accounts, but these are all credits to the capital accounts. So for A, I'm going to put a $9,750 credit there. Oops. So that was $9,750 for A. For B, $29,250. And for C, $39,000. Okay, so that, as you can see, these carry a credit balance. So to add to the capital account, we've added more into the credit balance side. And this is going to be income share. Okay, so this is basically dividing the net income up between the three partners. And if instead, if the expenses had been greater than the revenues for this period, instead of their income share increasing their capital account, they would actually be sharing a net loss. And so these numbers would be divided up and would be debit entries to their capital accounts. But that was not the case. Okay, so I took care of this one just now, and now I still have 1, 2, 3 more entries that affect the various capital accounts. But these are all debits because these reflect money that these partners have taken out of the partnership. So A took $9,000 out, so that's going to be a debit to A's capital for $9,000. B took $27,000 out, So we will debit B's capital account by $27,000, and C took $49,000 out, so we will debit $49,000 into that one. Okay, so now we have into the T-charts put each of the transactions that we recorded in these journal entries, and now we just want to see, okay, after we basically sum these up, what are we left with? So we'll basically add the credit side, subtract the debit side, and since each one of these have considerably more money in the credit side, we know that we're going to end still with a credit balance in each of these accounts. So for this line here, or I'll skip a line so we know it's the current balance instead of just another component of the entry. And I'll just take this cell plus this cell minus this cell. So my current capital balance for A is $22,750. And I'll do the same thing for these. This cell plus this cell minus this cell, $52,250. And then last but not least, that cell plus that cell minus that cell. And that will be my balance. Okay, so using the T-charts, that's what's in each of the various capital accounts. And finally, we need to prepare the June 30 entries to liquidate the partnership, assuming non-cash assets are sold for $120,000. Okay, so starting with that conversion of non-cash assets to cash, we are going to debit cash. Remember, this is the partnership's perspective still, even though we're liquidating. So the partnership has increased cash by $120,000, and we have decreased non-cash assets by, what was the value of those on our books? Okay, we're showing that they were worth $117,000. So we will take $117,000 out of the asset account called non-cash assets. So that's what this credit entry is for. To balance, we're missing $3,000 on the credit side, and that will be a gain on disposal for $3,000. Okay, so now what I'm going to do is I'm going to take that gain on disposal, which functions more or less like net income, and I'm going to divide that between the partners according to this little metric that we have here. And so instead of scrolling back and forth, what I'm going to do is just copy that and paste it down here so that I know what the decimal value for each of those is. So this was a credit balance to gain on disposal. To eliminate that balance in that gain on disposal account, I have a debit there for $3,000, and so now that has a zero balance between those two entries. And I will record a credit to each partnership's or each partner's capital account. So this is going to be credit to A's capital, and it's going to be $3,000 times the percentage that A shares in the partner's profits and losses, and I'll do that same thing for each other partner. 3,000 times B's share and 3,000 times C's share. Okay, and you see if you add those all up, that balances. So that takes care of the non-cash asset change to cash. And now all we have, that takes care of our assets in the liquidation. We're left with cash, and that's good because we're now going to use that cash to pay off any liabilities that we show. So we'll scroll back up here to our trial balance. Asset, here's a liability. We have a note payable for $32,000. So before the partners get any share of the leftover cash, we got to eliminate this liability because liability holders have a higher preference in the liquidation process. So we've got a $32,000 note payable that we need to get rid of. So liabilities carry a credit balance. So to get rid of liabilities, we need to debit them. Debit of $32,000. That closes out my liability. We paid that with the only asset that we have left, which is cash. And there we go. So non-cash assets taken care of, liabilities taken care of, and all we have left to do is distribute the amount of money that is left over, the cash that's left over. So to do this, what we need to do, first of all, we need to know how much cash do we have left over. And there's two different ways to do that. But I think the easiest way to do it, given the fact that we have 3 partners, is just go up here to our initial balances. We see we have $33,000 here. When we sold these non-cash assets, we sold them for $120,000 cash. So 33 plus 123 is $153,000. And the only thing that we took cash away from is this right here. Okay, so we had $153,000, and we're going to take that $153,000. We're going to subtract out that amount, and we're left with $121,000. The other way you can do it is you could come up here and look at the capital accounts, and this is a little bit more dangerous way of doing it because if you made a mistake somewhere, this will give you the wrong number. But you'll see when we work this out that these will be 2 equal numbers. But basically, after you've eliminated any liabilities and the only asset you have left is cash, whatever the cash balance is should be equal to what's in the partner's capital accounts when you add them up. Now, it won't be the same right here because in these 3 we've not added in the additions we made to their accounts through that $3,000 gain. But if you added that $375, $1,125, and $1,500 to these numbers here and then totaled all 3 of those up, you would get to $121,000. And you'll see that right here because what we're going to do here is we're going to take this $22,750, we're going to add $375, and real quickly we're just going to total that up. And that gives us $23,125. Then here, $1,125. We'll add those 2 up. In here, $1,500. Remember, I'm just getting these numbers from right here, this division of this $3,000 that we already did, and add that up. So these are my final capital balances, and you'll see if I just add those up, this plus this plus this, I get $121,000. Okay, so for the final portion of this liquidation entry, I am going to debit each partner's capital account. Whoops, debit A capital, debit B capital, debit C capital. This is me closing out each one of their capital accounts, 23,125, because I am paying each partner, or each partner is taking their share of what's left over of the company. So they're divvying up this cash. My final entry is the credit to cash. and that's my final entry. This reflects me divvying out what was left of the partnership, which has all been converted to cash. Eliminating that cash, each partner gets their share. That's how you do this problem.